Why are you saying that, and what are you recommending?
Well, Bob, we've seen concerns among the advisor community for the past year, and there have been areas like gold, which hasn't done as well, but energy, agriculture, base metals, a lot of those inflation areas that hedge during these times have done quite well. Two of the biggest by Invesco are up over 40% so far this year, and that's without gold participating. Gold tends to be a second half player. So if we do see continued inflation and rising rates into 22, I think we're going to start to see gold kick in as well.
You know, John, talking to you, I noticed you have a similar call speaking to you in the last week. You say inflation themes will dominate, will be less focus on crypto and less focus on disruptive growth. Explain that for us.
Yeah, I just think, Bob, last year was a perfect storm. You had COVID lockdowns, you had supply chain bottlenecks. So it was a perfect year for inflation to rise. And, I just think that, there aren't enough tools out there that can provide, a one ticker solution for investors to kind of not only just protect. See, you said an interesting word. You said protect against inflation. We at Story Advisors think you should, look to embrace it and not only embrace it, but look to benefit. And that speaks to Tom's point, which is that things like cyclical stocks and pro-cyclical commodities like energy and base metals actually do well when inflation rises. So let's change the narrative away from protecting, but to benefit from inflation. Because when I turn on CNBC every day, all I hear is guests on your show talking about how inflation is structural and it's here to stay. So I think we have to discuss a different narrative for inflation.
I want to go back to the stock selection point, because this is the question I get the most from investors here. The mean reversion question, I call it. Growth, mostly technology, has outperformed everything since 2009, since the Fed got very aggressive with monetary policy. And particularly in the last 5 years, growth and tech primarily has outperformed. So the question now is it time for value stocks, the pharmaceuticals, the banks, the energy stocks to shine? Tom, your thoughts on tech in 2022?
Well, they've already started, Bob. VLUE was up almost as much as the S&P 500 in 21. And obviously, from a valuation standpoint, those stocks are on sale compared to the stocks in the S&P 500. And as we talked about earlier, the equal weight strategy in the S&P 500 did just as well as the cap weighted strategy. So the good thing is we're already starting to see more participation across all stocks. And then again, as you talk about the big swing that we saw in growth versus value in the last 10 years, the divergence that we've never really seen before, things do eventually get back to the mean. And if you do have a diversified portfolio with both growth and value, you should do well over time. I think some of the areas that we continue to be concerned about is small cap participation hasn't been as great. Developed markets, emerging markets, again, not as great. But from a valuation standpoint, they look really on sale compared to the S&P 500.
John, your thoughts on growth versus value? I mean, I know energy had a good year, but energy's 3%. What about growth versus value? And what about international stocks? They've also underperformed the United States over the last decade.
Yeah, I think, we talked about value when I was on your show back in June 2020. June 2021. And, it's, as you said on that show at the time, it's like an old school ideology. And, I think at the end of the day, what works is that after a recession, like what we had in 2020, what typically works is value, inflation-linked strategies, cyclicals, and that, we expect it to continue. I mean, the last 10 years, you've had this proliferation of tech and growth because interest rates have been in a secular decline, and, tech companies, their value increases when you discount future cash flows. But as interest rates go up, I think tech stocks are going to be challenged. I started my career, Bob, energy stocks are 25% of the S&P, now they're 3%. You mentioned cryptocurrencies. Yeah. Energy stocks, the XLE, basically performed the same as Bitcoin last year, but Bitcoin has these massive, fluctuations and massive volatility. So what's interesting is that, energy stocks actually outperform crypto on a risk-adjusted basis. And I think that's going to, continue for the next year or two. I think you're going to see a lot more rotation into the value, inflation, cyclical trade.
Yeah, I would hope so. I'm an old school guy. I'm a, Jack Bogle disciple myself, founder of Vanguard, have been a disciple for many years. And we all know, all three of us, that over long periods of time, historically, value has outperformed growth and small cap has outperformed big cap. But it's been a long wait. Those guys who are into that philosophy have had a tough 10 years, and particularly a tough 5 years. So there's a lot of people saying, okay, Bob, when? And it's a tough call to make. I certainly believe in mean reversion, as you guys probably do. I certainly believe it's time for them to outperform. And the fact that the S&P Energy is 3% of the S&P, as John says, is astonishing to me, given that Exxon was the biggest company in the United States 20 years ago, Exxon and General Electric. So I keep waiting for that to happen, but I have to say, other than the interest rate rise, there are compelling arguments for keeping in growth, other than the interest rate problem that's happened many times. I want to move on and talk a little bit about inflows. It was amazing to me that in a year dominated by ESG and thematic tech investing, most of the inflows were into plain vanilla ETFs. We had $900 billion in inflows. Tom, you and I talked about this. And most of it, I'm looking at the top 6 list here. It was all S&P 500 ETFs that dominate the market, or the triple Qs I see here. That's the NASDAQ 100. But that's pretty amazing. Just on an inflow basis, with all this talk about crypto, all this talk about, small thematic tech investing, most of the money went into, again, the index guys, won out. And Tom, will that continue into 2022? What would reverse that?
Well, not a lot, Bob. I mean, it's just another great reason what ETFs are all about. It's diversification, it's low cost, it's tax efficiency. The first S&P 500 ETF that was put on the map back in 1983, it continues to be for all the right reasons. As more and more investors have shifted away and almost lost confidence in active management, they understand that core investing and core diversification is key and critical. More and more advisors have models that are wrapped around these core indexes. And we're going to continue to see flows as we've seen money come out of active mutual funds at the rate that we've seen money going into ETFs. So it's all for the right reasons. It's really fun to talk about thematic strategies, crypto, gold, things like that. But when you look at where all the money's flowing, it's in those basic indexes and the ETFs around them.
Yeah, John, you've had a very simple approach to this for a number of years now. You've advised investors to keep 70, 80% of their portfolios in low-cost index funds, and then take the rest and try to add alpha. You advise still using thematic tech. Is that balance still right? Take 70, 80%, put them in low-cost index funds, and take the rest and try to get some alpha? And where do you get alpha this year?
Well, I think that, that should still be the message. At the end of the day, actively managed mutual funds last year had $400 billion of outflows. So that big number you just mentioned, I look at that as being reduced because a lot of it is just people continually shifting out of active management into passive. And I think it's because active managers just don't take enough risk. They charge too much. But yeah, put 70-80% of your ETFs and tickers like VTI, IEMG, IEFA, and then use like a sleeve of 15-20% in things that you believe in. So we had to start advisors believe in inflation. So we've got strategies to kind of benefit from higher inflation. So I think your core should be cheap. You should hold it forever, and then on the margin you change your sleeve periodically, depending on what are the latest trends in the marketplace.